Reviewing adjustments is looking at internal transactions or events. So why are adjustments necessary? Well, it all goes back to GAAP, the revenue recognition and the expense recognition rules, which is also called the matching principle. Now, there are three categories of adjusting entries. There are prepayments, which you may have heard them called deferrals. There are accruals, and then there are estimates. A prepayment or a deferral, this was when cash has already been paid or received. Prepaid expense, this represents an asset, so you're going to need to record an expense gradually as the asset is used up. On the other side, unearned revenue represents a liability, so when you do earn it, you need to record revenue and remove the liability. An accrual, this is when cash has not been paid or received, so you may have accrued liabilities, accrued receivables, so adjustments need to be made. And an estimate, the example we will use is allowance for bad debt, but there are other types of estimates. You can have an estimate for warranty expense, for example. So you need to adjust your accounts receivable to its net realizable value, and that is based on an estimate. Now, depreciation, let's look at this. While it technically is an estimate, it falls into the category of a prepayment. And that's because you've already purchased the asset. So cash has been transacted. Depreciation is just how you spread the recording of the expense over its expected useful life. And this, of course, is according to the matching principle. The key to remember now is depreciation has nothing to do with valuation. Even though you may hear the term book value, it's not a valuation. It's a cost allocation. You're moving a small amount of the total cost of the asset to the expense on the income statement. The asset was prepaid, so it needs to be expensed gradually. Remember, though, the calculation is an estimate. The type of adjustment is a prepaid. So we'll look at the difference between a deferral and accrual. So if you have a prepaid expense, best example probably is prepaid insurance. Recorded as an asset, and then your adjustment is to gradually remove the asset and record the expense as it's used up. On the other side, unearned revenue, liability. You were paid, but you haven't done the work yet, so you need to do an adjustment when you do the work to record the revenue following the revenue recognition rules. An accrual, the way to remember this is no cash has been received or paid. You'll have accrued liabilities, accrued receivable. Now, the difference between a deferral and accrual is cash has not been transacted, so there was nothing to record. So your adjustment is to record the expense and the payable. On the other side, same thing. Nothing has been transacted, or nothing has been received with cash, so it's an accrual. Your adjustment is to make the correct journal entry. Estimates. To adjust your accounts receivable to its net realizable value using allowance for bad debt. Now, remember what your normal balances are. So even you can think about two different assets here, actually. You can think about net realizable value of your accounts receivable, your asset. Your contra asset is that allowance account. But when you're talking about the depreciation estimates, you also have an asset and a contra asset. So what is your adjustment? You're not going to decrease your asset account because you need to make sure you maintain historic cost of that asset at all times of the total of accounts receivable. So you use the contra asset. You set up that allowance account when you record bad debt expense. Okay, so now if an asset goes down and an income statement account went up, the expense account, the question is, when is an expense really an asset? When it's a prepaid and unused. Let's look at another one. So if a liability goes down and revenue goes up, what happened? When is revenue a liability? Before it is earned. Another Another nice way to try to remember what is an accrual. Well, it has to be an able. It'll be a payable or a receivable. So for the adjustment, it's going to be the payable and the expense account that will be used. And for a receivable, it's an able, so it's an accrual. You have a receivable and revenue. Now, usually what is taught is the balance sheet method with accruals and deferrals. You initially record it on the balance sheet. The entry was the balance sheet went up, the income statement account goes up for accruals. And this is according to these GAAP rules. For deferrals, it's going to go the other way. Balance sheet will go down, the income statement account will go up. And again, it's because of the same GAAP rules. The only difference between an accrual and a deferral is, has cash transacted yet? Now, there is an alternate method to handling prepaids. You don't have to record prepaid insurance. You can record it differently. So we're going to look at these side by side. The balance sheet method, which most accounting principles courses teach, and then there's an alternate expense method. Cash went out, you bought prepaid insurance. Then your adjustment is to decrease the prepaid and record the insurance expense. But it's okay and perfectly acceptable to record the entire insurance policy as an expense, as long as at the end of the year you make your adjusting journal entry to put some of that on the balance sheet. So really the key difference is, am I going to record a balance sheet prepaid initially or wait till the end of the year to adjust it? Either way is acceptable. Remember the three categories. A prepaid is a deferral, then you have an accrual and estimates.